Hi folks, David Waring here again with InformedTrades.com and the next video in a series on Trading the Economic Crisis by Simit Patel. In our last video, Simit gave us a great overview of how he feels we got to the point where we are today with the economy so we can better understand where he feels we may be headed in the future. In today's video, we're going to look at the key question which is being debated in the markets right now, the answer to which will have enormous implications on the future price direction of all markets going forward. So let's get started.
Okay, in this video we're going to talk about inflation and deflation. Those are sort of the key issues, or that issue of inflation versus deflation is sort of the key economic issue, and once you sort of understand that issue and sort of come to an analysis of it, then you can sort of base a long-term investment strategy based on your understanding of what's going on in the economy. So let's start with defining the terms. Inflation is simply an increase in the money supply. So if there's more money in an economy, more dollar bills and credit and things like that, ways of purchasing goods, then that's inflation. And inflation is typically characterized by rising prices. So if there's more money chasing goods and services, then prices will rise, and that will tend to be inflation. Deflation, on the other hand, is a decline in the money supply. And deflation is the opposite of inflation in the sense that deflation is characterized by falling prices and rising unemployment. So if inflation is the problem, it's prices being too high, that's the problem. Whereas if deflation is the problem, then it's an unemployment issue and people are out of jobs, and that's the problem. Now, up until the middle of 2008, the environment was in the United States economy was clearly inflationary. We saw the housing bubble. We saw high gas prices. We saw a high stock market. And then in the middle of 2008, the housing bubble popped, and that sort of set off a deflationary environment. So there was a switch from inflation to deflation. We saw the stock market come down significantly, housing prices come down significantly, banks and insurance companies failing, and unemployment rising significantly. Now, once deflation kicked in, we saw the U.S. government increase its spending significantly in the form of bailouts in an attempt to sort of hold off the deflationary effects, to prevent unemployment from reaching new highs, and to curtail the amount that the stock market would fall. Now, the key question is government spending inflationary? So will government spending ultimately end up resulting in higher prices? Now, the answer to that question sort of depends on how you measure money supply. Certain economists, or many economists, use something referred to as MZM, and that's what's on the screen now. And if you look at MZM, then the answer is yes, government spending is inflationary. There's something called M prime, which is a narrower measure of money supply, and looks more on the use of credit in credit markets and the role of money. And that would say that government spending is not really inflationary. So there's various views, and it largely depends on how you measure money, or count money. Aside from the strict money supply calculation issue, other deflation arguments that argue that we're in a deflationary spiral and deflation will be the long-term trend is that the first argument is that banks won't lend. And under our Federal Reserve System, all money comes out of debt. So if banks aren't lending, then the money supply won't be increasing. Banks right now aren't lending because there are no credible borrowers. So until that issue is resolved, until debts are paid off and bank lending can resume, there won't be inflation. The other argument that deflationists offer is that consumers are paying off debts. So even if consumers are given money, they're using this money to pay off debts, and a decrease in the supply of debt is under the Federal Reserve System is also going to decrease the supply of money because all money comes out of debt. So that's a deflationary factor as well. Third argument that deflationists use is that prices won't rise above consumer demand. So if unemployment is high, if wages are falling, and consumers are saving and paying off their debts, then they're not really bidding up prices like they do in a housing bubble or a stock market bubble. and so prices won't rise above their demand. Fourth argument is that this is just like Japan in the 90s, meaning what the U.S. is going through now is similar to what Japan went through in the 90s, which was a long, over a decade period of deflation. And the fifth argument that deflationists use is that the Federal Reserve, which is the central bank of the United States, cannot inflate no matter how hard they try. So the Federal Reserve has said that they want to inflate and they want to fight deflation and will do whatever it takes to fight deflation. Won't allow deflation. But that deflation will argue that it doesn't matter what they say because they're not able to stop it, largely because of the previous 4 points mentioned. Inflationists, on the other hand, say that government spending makes up for the lack of lending. So even though consumers may not be borrowing and banks may not be lending and consumers may be paying off debts, it doesn't matter because government's still taking on debt by borrowing from other countries or by printing money, so they can make up for lack of spending on the consumer side that way, and that will ultimately result in higher prices. The other argument that inflationists make is that the Federal Reserve can inflate if it wants to. In my opinion, this is a really critical issue. If you view the Federal Reserve as a central bank that can sort of print as much money as it wants and buy up as much assets or as many assets as it wants, that's the argument that it can inflate. The deflation will say that the Federal Reserve can print money, but because banks aren't lending, that's not going to do much. The other argument inflationists use is that there's a risk that the U.S. government will print too much money, and that could lead to a run on the currency. So that could end up increasing the money supply or decreasing the value of the dollar and sending prices up significantly if everyone runs away from the U.S. dollar. If they're saying to themselves, the Federal Reserve is printing a lot of money, this is going to devalue the dollar, I want to get rid of all my dollars, I want to get rid of all my U.S. bonds, which are denominated in U.S. dollars, or get rid of all my dollar-denominated assets, that's going to send the value of the dollar down significantly, and it's going to send prices up significantly. The other arguments that inflationists use is that exchange rates can push the price of imports above aggregate demand. So even though consumers aren't bidding up prices and they're saving and they're paying off debts, the United States in particular is a company that imports many of its products, and if the dollar is weak against other currencies, then the price of those products is still going to be higher priced in dollars regardless of what demand is. That just means that if prices are above aggregate demand, that just means people won't be having those products, so they won't be purchasing them. And lastly, in terms of comparisons or historical precedents, inflationists will argue that the U.S. is in a scenario right now that's similar to Argentina and Iceland, both of which had economies that were in a bubble. Then the bubble popped. The government responded with more government spending, and eventually there was a run on the currency in both those countries. And inflationists will argue that the United States is heading down the same path. Now there is something else referred to as stagflation, which is the combination sort of inflationary characteristics and deflationary characteristics. So deflation is characterized by unemployment and falling wages, falling wages and unemployment, and inflation is characterized by rising prices. So stagflation is sort of the worst of both worlds in the sense that unemployment's rising and prices are rising as well. And we saw a little bit of stagflation prior to when the housing bubble really collapsed in 2008. I'd say 2007 was more of a stagflationary environment, and maybe the first half of 2008. Most people think of the late 70s in the U.S. as a time when there was a lot of stagflation, where prices were high and unemployment was high as well. So it may be that we're in for a deep stagflation in this economy. That's what many are arguing as well. That's about it. Once you understand the inflation and deflation issue, you can determine an investment strategy for this economic crisis, and we'll get into that issue in future videos. Thanks a lot for watching, and as always, if you have any questions, you can visit us at informedtrades.com. Thanks.